Welcome to this week's YouTube video. This week's video is going to be different because we are shooting on a Saturday. We don't have time to get it professionally edited. So I'll just be speaking to you on the camera, and I'll try to keep it informal and try to reassure many of our clients about the recent dip that has happened across the market and also in our portfolios, how our models acted, is anything actually going wrong, and is there a cause for you to worry? So firstly, the small cap correction has been pretty significant. Many of the stocks which were favorites of investors have all ended up seeing from 20 to 40% correction over the week of January. If you look at the Nifty versus small caps, both corrected since September. Nifty is sitting at a 15% correction from September highs, and small caps have now gone up to 20%. But before last week, they were almost at par, and in the last week, there has been a meltdown in the small cap stock. But obviously, a 15% hit, a 20% hit is not easy. People have large amount of money tied up to the equity markets, and they have their concern that is something going wrong? Am I going to lose all my money? When you're looking at equities, when you're looking at strategies like what we offer, you would see that people talk about drawdown levels. They talk about risk, and this is what the drawdown is. A correction like this, it is the 15th biggest correction that has happened in the Indian market since 1990. And it is the nature of the market. Wherever stocks go down this sharply, they also come up in a significant fashion. This is nature of equity investing. We are all aware that we are investing into the market and risks like this happen. And this is a significant risk that we have seen early in 2025, but we are confident that the stocks that we hold are all pretty fundamentally strong. They are suited for the current scenario, and they should see a bounce back as and when the recovery happens. Now, another big question that I get asked by many of our investors who I have spoken to, who I have onboarded into my PMS, they will tell you that you said that maximum correction that your strategy has seen historically is 18-20%. You're already touching around that number, 15% correction in January almost, and then there was some correction in the last end of December as well. So is something going wrong with the strategy? The answer is very clearly no. We tend to follow our strategy very strictly, and we also analyze it deeply. The strategy was opportunist in this scenario where it did end up having slightly high allocation to small and mid caps, and that is understandable. But as if when the correction is over, the strategy should pick up. We've also, as per our rules, done a lot of risk management. So we went to cash periodically. I think even in January, when we started, our factor strategy was holding almost 5% cash. And then we had 5% gold as well. Then we have sold stock at various times in the last week. We booked losses, so your tax liabilities will go down. And we've also been hedged for the major chunk of January, right? So we bought hedges in the Nifty. Unfortunately, we were holding small caps and Nifty did not go down that well. So the hedge was not exactly suitable in this scenario. But we are prepared right now that if the situation goes any worse, our portfolio is hedged really, and we have cash levels also. After the budget, we've also actually gone and bought some stocks in the consumption segment. We all saw that in the budget, the biggest announcement was that the tax slabs have been cut. And as the tax slabs get cut, consumption will be boosted among the urban middle class. And that is why we have actually bought a few stocks, which are these high performing stocks in the consumption segment, which actually went through some correction. We have topped up on those, and I think it's a good opportunity to get into those names. And I think seeing this pain, especially in the beginning of January, we are confident that now with the rate cut that is coming and a budget that has instilled a little bit of confidence among the public, we should see good recoveries in the market. Now let's talk about why did this small cap dip happen, and could you have anticipated it? Could we have done anything better? There can be various reasons that you can attribute it to. Number one, global macroeconomics. Donald Trump has come. He's threatened traffic rises across the board. He's going to be very aggressive against foreign trade. That could lead to, drawdowns in emerging markets. So in a country like India, we've seen FIIs exiting. We've seen people sort of booking profits or booking their positions, possibly moving towards the dollar. Along with global macros, I think There is also a local sentiment due to the fund flow shifting out of India. There has been a sentimental hit. There's been a very volatile scenario over the past 3 months, and that has led to some sentimental hit to the small cap segment. There's also valuation concern. We all know that earnings last quarter and even this quarter are not coming out very nice. You're seeing revenues flatten and margins are at a top. Companies are optimized really well. They cannot increase margins further to make their EPS go up. So the only companies that will shine here are those companies which have drivers of high growth. And we did a video where we talked about what are the high growth segments that are there. But the valuation concern on the overall market has led to this sharp correction, I think, in the small and mid cap segment. Now, why was this decline really sharp? Number one is because maybe some of the large mutual funds which have flexible portfolios ended up selling some small caps, and small caps have low market cap. So when there's a large selling, they get hit very sharply. Second reason could be, which I hear across the board, is that many investors stayed on the MTF margin trading framework. So what happens there is the moment your limits are hit, you put 100 rupees, the moment it hits 80, your broker liquidates your positions. So if that happens, there is mass selling that would happen that leads to sharper correction. So that could also be one of the reasons. And earning growth perception is that we are seeing a flattening of earnings. We might not see upgrades this quarter, but maybe next quarter. And it is not just our portfolio that is corrected. You look at some of the top performing mutual funds, right? Some of the mutual funds that have actually done pretty well in the last year, you would see that even those mutual funds have seen similar correction like ours. Many of the PMSs, many competitors that I track have all seen similar sort of corrections. Even your small cap, mid cap index is sitting on significant correction. Nifty, on the other hand, has seen less than 10% correction. But there has been this correction across the board. And I'm not saying that we could not have done this better. If, let's say, we were sitting only on Nifty stocks, then obviously we would have done better, right? But that's not the nature of our strategy, that it will go directly to Nifty. Obviously, we can improve and try to anticipate these situations better, have rules in place in our system that switch over to larger cap universe, maybe a little bit proactively. But I think this is a short-term phenomena hitting every portfolio across the board. And given that we could see a sentimental increase and India continues to remain the fastest growing economy in the world, so we would see, I think, a good recovery from these bottom levels. So many of my investors, they never come back and never talk to me about performance. And I've received so many screenshots where they're saying, see, now January we wiped out so much profits, right? And what I tell everybody is that bottom of the market is not the best time to probably look at your portfolio. The portfolio would recover and you cannot time how long does it take for the portfolio to recover. There's some excellent opportunities present at the bottom. We are building those positions and we are gearing up for recovery in these markets. And again, I'll reiterate that many of the companies that we actually hold are pretty solid businesses, right? I follow so many analysts and brokerage reports which come in and institutions who are sending us their analysis. And every day I get upgrade notifications, I get higher target prices for the companies that we are holding. But once in a while, you have such scenarios where there is just panic selling. And this is what you have to actually understand if you want to be in the equity market for the long term, that these scenarios happen, right? These scenarios will happen. For some people, they happen early in their investment journey and they get worried. But many investors who have been in the market for the long term, they know that such scenarios happen. It's actually a good time to go and top up your portfolio when you see such sharper corrections. Historically, actually, if you look at the history of correction, like I said, this is the 15th biggest correction in the Nifty. And however time it would have taken for the market to correct, it typically recovers in the same time period itself or around that time period. So we're looking at a similar time period for a recovery to happen from these levels. And we are definitely very proactively monitoring our strategies and our themes and see how they adapt to the changing macroeconomics also. Now let's talk about another question, which is how did we handle the situation? What did we do? So first of all, I'll tell you that risk management is a core theme in our portfolios. We have multiple layers of risk management. The first layer of risk management is obviously that there is good amount of diversification. The stocks that you're holding are from different sectors and industries. It is diversified, which lowers the second layer of risk management that we have is depending on the market regime. We go from high risk factors to slightly low risk factors. So even right now in our factor strategy, the focus is actually there on value based and low volatility based factors. But even though you have good stock, there can be scenarios which are very rare in nature where you see panic selling, where people are not even looking at fundamentals. People don't care about earnings, and the stock comes with an excellent earning, and next day you are seeing a 10-15% correction. Now, the third thing that we do for risk management is deallocation. So even in this particular scenario, like I said, our factor strategy had 5% gold and around 5% cash at the beginning of the month also, and during this correction we have sold stocks and we were sitting on 20-25% cash at one point in time. We also have hedges in place which we deployed in the mid of January and again a week later. So those hedges ended up being a little bit tepid, and the hedges are like a risk policy. We only want them to be there to protect us from very sharp correction. We continue to hold these hedges with the big event of the monetary policy coming in, after which, depending on how sooner the VIX cools off and how the recovery happens, we will liquidate those hedges. Now, obviously, we are not consuming a lot of cash to hedge. We only use a very tiny amount of cash to hedge your portfolios. These four layers of risk management, which we think are really powerful and which will also help us in the recovery process. But along with that, I just want to reiterate that our models that we're using, they are a little bit opportunistic in nature. They are going to businesses and stocks where we see a bigger potential, right? And when you see a bigger potential, that is where you would see these portfolios maybe outperform the benchmark in the longer term. Or maybe bottom of the correction might be the worst time to actually look at your portfolios. But this is the nature of equity markets, that you see recovery happen from such panic situation. In situations like these, what helps us stay calm is, number one, that you have to understand that these type of corrections happen in the equity markets. Periodic corrections are part of the process. I think many of investors have a lot of confidence in us. They think that we are going to manage every risk scenario beautifully like we did around the election season. But in this scenario, what happened was the correction was deeper into small cap segment where we had allocation, and the Nifty hedge did not work that much. Another thing that I would add is that we do take calculated adjustments. So we have done some exits, but we have not been very reactionary. We don't want to panic sell. We don't want to hit the market every time you see some correction, because the sharper the correction happens in these wonderful businesses that we are holding, the faster the recovery would also happen, because we see the potential of growth in the companies that we are holding in the immediate as well as long. So should you be worried about this market crash? Obviously, such crashes, while theoretically you can say they happen all the time, but when you're looking at your statement and you see 10-15% correction, you get worried, right? I think it's the best way for people who do not understand the nature of equity markets to understand that market corrections are a critical part of the market process. They do happen once in a while. They keep our valuations healthy. They keep our market healthy. They lead to sector rotation. They lead to finding better opportunities. And if you add risk management on top of these scenarios, you can end up doing better than the market. Now, obviously, budget session has also come, so we have to look at it. It had a lot of interesting things. We'll talk about it later, but it has given a direction to the market that maybe consumption is the theme to bet on in the near term. Similarly, RBI policy is coming next week, where when we see a rate cut, it will give a sentimental boost to the market. So there is actually immediate term rationale for stocks to recover. And we hope that the excellent company that we're holding will recover pretty soon. So in this scenario, what you should actually do is avoid any sort of panic selling. Selling at the bottom is actually the worst time. Now, the businesses that we're holding, and I won't name many of them, for example, Supriya Chemicals, Swaraj Engineering, Transformer Rectifier India Limited, stuff like that, you will see there is a strong growth path ahead for these companies in terms of earning growth, in terms of revenue growth, and they will be attractive companies in the near term. There's a panic selling that has happened, and we don't need to participate in that panic, and we have to avoid that panic for us to actually get the potential of the companies that we are holding. Secondly, it's very important to understand the fundamentals also. Obviously, we follow a quantitative model which looks at fundamentals, technicals, and other factors. But it is important to understand that there's a reason why we are holding. Therefore, I read a lot of reports about the companies to understand that what's the worth, and we see fundamental worth in the companies we are holding. So I think that is the reassurance that you have. Finally, we have been opportunistic where we have bought even in December, we have bought even in early January, but there was a sharp correction that happened. So you have to be cautious about buying as well, and it has to be selective. Right now, the stock that we are buying, we have a slightly large cap tilt. Right now, the stock that we are buying have a slight consumption tilt, and I think you have to be selective in what you're buying right now. But yes, what we are doing for you is we are maintaining the core positions, we are hedged till the big events are done. We are proactively monitoring the portfolios. Rest assured, we are looking at a 360 view of the stocks and making sure that we are not in any stock that can possibly ruin the portfolio. We also have cash reserves in the portfolio as and when needed. And nobody can tell you when does the correction get over, or what is the amount of correction that can happen, or what is the return that you're going to get in the next 1 month or 3 months. But what I can tell you with a lot of reassurance is that the strategies that we have are excellent long-term strategies. And wherever you are investing, you have to invest with a long-term vision. You can invest with an active strategy like ours, which switches between sectors, or you can invest into an index, which is relatively static. You should have a long-term vision, and actually panicking in this dire situation is the worst case scenario for you as an investor. Now let's come and talk about the budget, right? I think budget was extremely interesting. There were a lot of positive things that were discussed. The FM actually started with announcements about the agriculture segment, where she said that they're going to give a lot of incentives to the agriculture farmers. So there's going to be easier credit that is available. They'll train them with skilling. They'll use technology to make their lives better. Even though there was a little bit of subsidy reduction that happened in the fertilizer segment, agriculture in fact had a mixed sort of a reaction. But we all know that government would have a big focus on the segment, and it is an excellent pick for the next few years. Along with it, I think the MSMEs got a lot of mention, and there are going to be some tax stops for MSMEs, and the ease of doing business might get easier with lesser regulations. The government did talk about infrastructure development, especially in the shipping and shipbuilding sort of segment, and so that segment might be interesting for us to look at. But there were no big capex plans that were announced. Like the budget that happened a couple of years ago, I think people are spoiled that they think that every time a budget comes, you're going to get some big spending from the government in certain specific segments that are going to lead to big rallies. Obviously, even in this budget, we saw some big announcements, but they will have long-term impact. And in the segment that got attention, I would say it would be the rural segment, it would be the agriculture segment, it would be, I would say, the services segment, skilling, innovation, and even some aspects of infrastructure. But yes, the big announcement that happened was the tax relief that people are going to get. This is especially focused for, I think, the urban middle class. People who have salaries less than 12 lakh will be tax exempt. And even on the above slabs, there will be certain benefits that people would be getting. Now, tax reforms, how do they relate to where we invest? Obviously, retail in India has tasted blood from the market, and they actually see the long-term potential. So I think some amount of money is going to come into the stock market and boost maybe some of the stocks that we hold. And I think on the other hand, there's also going to be an uptick in consumption. You've seen some slowdown happen in the urban consumption, and that recovery could happen after this budget. So we're seeing stocks like Zomato, Trent, and all rally like anything. So focusing on consumption might be a very good time, and these stocks are actually available at a discount. So could be a great time to buy after this budget. The government also kept its focus on fiscal prudence, right? They don't want the deficits to go very deep. If you guys remember the markets before 2000, right? I think fiscal deficits were a big thing. How well does India manage its fiscal deficit was critical. And if that got bad, Indian economy tended to be impacted a lot by global events. So the government right now is practicing fiscal prudence, and I think that's a great thing. And even with a fiscally tight stand, they have kept the growth projections higher and they have kept the inflation projections lower, which is, I think, a big positive. Now, after budget, another big thing is coming, which is the interest rate cut. From 5th to 7th February, the RBI is going to have the MPC meeting where they will decide on the level of rate cut that could happen. We hope and expect that there will be the first rate cut for India, a 25 basis point. That could happen potentially next week, which will be a big sentimental boost because as the rates get lower, it's easier for companies and people to borrow capital. If companies can borrow capital, then they can do more capex. If they can do more capex, that will lead to more top line growth and better profitability. It would boost the banking segment, the NBFC segment, and it would be a big sentimental impact on the market itself. So that is something that we are now waiting for. Obviously, if RBI does not cut rate, that's a different story altogether. But I think the consensus that is being built right now is that we could expect a rate cut possibly in the next week. Now, coming back to the market and where it is going, right? I hope I have explained to you the rationale for correction into our strategies and why it is not something that you should worry about. When I started my PMS, we started at a great time. The market kept on going, but some of the experts and the older managers, they would come and tell me, Sonam, stick it with the tough time, right? Because they all know it happens, right? And as a new manager, that's what they kept telling me. And I think that is the lesson that even investors have to have, that these things are part of the market and you should not let go at this bottom, because only after this you get the exceptional returns, right? For example, if you had sold your portfolio in 2020 at a loss, you would have missed this significant rally that have happened, right? So I would say sit tight. This is a correction that happens periodically in the equity markets. Have a long-term view, and that is where you will see the real capital appreciation. So talking about directions that the market could take, there is a couple of indicators that we watch in the market. For example, the sentiment indicator. Morgan Stanley publishes a sentiment indicator which fluctuates between fear and greed. And in that sentiment indicator, if you look at it, for the first time since that COVID crash, market has entered the oversold level, which means that this is a very significant correction that has happened and we are in the oversold level. So it might actually be a good time for recovery, especially after this budget, which is a balanced budget with some positive news and the rate cuts that might happen in the next week. Similarly, many of you guys might follow technicals. What you will see is only 18% Nifty 500 stocks are above their 200-day moving averages. Now, stocks going below 200-day moving average means that there's significant sort of drawdown that has happened. So only 18% stocks are above the 200 DMA. Only 8% are above the 50 DMA, which reflects that there is a widespread market weakness right now. Number of stocks that are hitting 52-week high are very insignificant. It's one stock that is there in the whole 500 universe, and number of stocks that are hitting 52-week low is in fact pretty high at 75. So that ratio hints at a lot of bearish sentiment. Even the FII short positions or the selling is at an extreme level, and if you look at history, when you see such sharp corrections and 4 consecutive months of correction, typically the market recovers from there. So these are all technical indicators. There's no assurance in any of it, but these are the patterns that we have seen and which sort of hint that there could be a pullback from these levels. This is this short, genuine video that I wanted to create. I just wanted to tell our investors that stay calm and stay disciplined with the strategies. We have to take advantage of the volatility with risk management, and we have to look at this volatility as an opportunity to maybe add more capital, in fact, because there will be recovery from these levels, or pick up some good, strong businesses to include in our portfolios. Our communication channels are open. I think our team is very accessible, but I wanted to address everybody in one video so that we don't have to take multiple calls. But we are very happy to explain any further doubts that you guys might have. What you have to remember is that right now there is the panic selling that is happening, but we have strong businesses with a good fundamental view of profitability and growth in the next quarters and years. So we are confident in the position that we are holding, and we are looking at risk management very seriously. For us, there would be no bigger achievement than safeguarding your capital, and we take it very seriously. What we would request is that you also focus on the fundamentals, keep a level head, and have that patience to not panic at the bottom. If you are actually ready and prepared to take advantage of this correction that has happened, that could in fact lead you to better prosperity if you actually add positions at the. That was my short video where I wanted to talk to our investors, talk to the broader audience on YouTube on what we are thinking about the markets. If you have any other questions, please do write down in the comments and let us know if this was useful for you. We'll see you again, possibly in the old format of our videos next time. Until then, happy investing.